Rajat Sharma, founder and CEO of Sana Securities, now joins with us. Rajat, good afternoon. Thank you for giving your time to ET Now. And it was the Diwali bonanza and the speech of Prime Minister Narendra Modi over the weekend, which gave a lot of buzz to the markets. And as we see, the markets are clearly cheering the GST bonanza announcement. And of course, even before the announcement could come in, the positivity stays in the market. At present, 24,888 level. And if we talk about the reports, big numbers, GST cuts are expected to spark around, let's say, $13 billion consumption boost is what is being in the talks. Now, how realistic you think this estimate is, and at the same time, are markets right in cheering consumption over capex according to you?
No, absolutely, 100%. And the reason is not just, how much of this gets percolated. The bigger reason is also because, consumption slowdown had led to depleted price to earnings multiple on a lot of the companies. And even with companies which were still looking expensive or looking expensive because earnings were not picking up. And I'm talking of frontline consumption stocks, whether it's FMCG or consumer durables, stocks like HUL. Now, I'll give a disclosure. HUL and Asian Paints have been my top picks since the beginning of this year, and I've spoken about it on your channel, your network itself. There has been so much of a slowdown in consumption that at some point it had to pick up. So even from a first there were income tax rates which were revised upward so that there would be more money in the hands of people. They would spend more. Now rate rationalization will benefit the most diversified FMCG companies, be it HUL or ITC. And keep in mind, the third thing that's helped is because of good monsoons, there could be, a downward effect on inflation. And, stocks like HUL, when raw material prices go up, they increase the price at which they sell their products, and then they pass it on to the consumers. But when raw material prices fall and their manufacturing cost falls, they don't really revise the prices downward. So that would be an additional profit which will get built into these companies. So right now, they're at a very, very sweet spot, consumption stocks. And I'm talking particularly of FMCG consumption, not really so much of consumer durables. I do know that air conditioners, cars, there would be lesser GST. Remains to be seen how long it takes or how much impact will that have. But for a lot of these smaller ticket size goods in FMCG, the result would be felt, in the next 1 or 2 quarters. So FMCG is a great, great place right now to get invested in, both because of, what the GST announcement has been and how the space has been for the last 1 year or so.
Sure, Rajat. Of course, the consensus view coming in from all the guests we've spoken today is that FMCG looks like the next attractive pocket on the back of these announcements, or the valuations, or the muted earnings, or like you said, they've not run up in a very long time, so it's only fair now that they do run up. But Rajat, other than the GST announcement that we've heard, the Prime Minister also spoke on a whole host of sectors like the need for domestic affordable healthcare and pharma. He also spoke about indigenization of our defense equipment. On one hand, he's also spoken about minerals exploration. There is so many themes that he has covered in that speech. Apart from the GST impact, which sectors are starting to look more attractive, or on the back of this government boost and government focus, going ahead, which sectors do you think could look attractive?
It's interesting you say that because, we've been discussing this ourselves at our office. And, one sector that's particularly looking very attractive to me is pharma. And I'll tell you why. There's no tariff news on pharma. No tariffs have been imposed on any Indian pharmaceuticals. They've been 25%, 50%, talk of 50% tariffs on a lot of the other sectors. The Prime Minister spoke about, indigenization of pharmaceutical companies. We should start manufacturing and rely less on US for, because a lot of our pharma companies, be it Dr. Reddy, Sun Pharma, Cipla, Glenmark, Gland Pharma and Glenmark in particular, over 50% revenue comes from the US. The funny thing is that, these stocks have started correcting, or they fell despite the fact that no tariffs were imposed on these. In fact, I think pharma is a big bargaining chip which India has to, get tariffs lowered on a lot of the other sectors with the US, because India supplies 40% of generics that go into the United States, and even higher percentage of biosimilars, 40, and I've checked that, 40. So, without Indian pharma being imported into the US healthcare system is not just vulnerable, it's completely exposed. So this dip, which happened in the last 1 or 2 months in pharma particularly, is just a great time to buy these stocks. Stick to the top 3, 4 pharma companies, whether it's, if you're looking at generics, just look at Lupin or Laurus Lab. Or if you're looking for, diversified companies, then top 3 companies, Cipla, Dr. Reddy, and even Sun Pharma. These are companies get 30 to 40% revenue from there. The talk of relying less on US and manufacturing and selling it within India is great. Be that as it may, that may take a while, but our reliance on US is actually a bigger problem for US than India. They cannot source these medicines from anywhere else because of the sheer scale and the pricing at which India supplies it into the US. I guess nobody talks about it in media or so openly, but I'm sure behind the scenes in negotiation, this is a big bargaining chip which we have. So this is a very interesting sector right now.
I completely agree, and that's such a sharp observation. The news flows at present are in the favor of pharma and automobile space, but one cannot negate the fact that the defensives, the pharma sector, will also keep playing the role as it has done always. And in fact, any dip is a buying opportunity as we speak. But moving ahead, PM Modi's Independence Day GST bonanza is getting a big thumbs up from market voices. Hiren with the steel staple and quick commerce gaining, with defense and semiconductors as long-term winners. Bernstein's Venugopal Gare flags only a marginal fiscal impact while staying bullish on retail and QSR. And Manish Dangi says GST cuts will fire up festive demand even as bonds look set for a strong rally. Let's listen in.
While staples will benefit, but I think a leveraged play on staples is actually to buy the quick commerce and the large big box retailers. I think they should benefit significantly from the volume growth that will ensue as a result of the tax cut. So I think the entire basket should do well, in my view. I think defense is a 10-year story in India. It's a decade plus story. It is very strategic. There will be significant investments in the entire semiconductor ecosystem.
So your fiscal deficit perhaps is a 10 basis point sort of an impact. It could have been much higher if you don't really truncate capex. So that's the broad number. I would probably say it's more or less manageable in the overall scheme of things for this year. I would say defense capex will be a bit more rigid in terms of spending given the geopolitical requirements this year. But outside of that, most of government capex could essentially see some sluggishness. Some spending towards the discretionary areas, especially retail or QSRs, which I've been selectively positive through the year because of other factors as well. Autos, not very clear as to what happens to the rates out there.
Should see a spurt in demand, and particularly it's sort of well timed because it's during the festive season. It should help actually the consumption. In India, what's missing right now in substantial manner is the leverage cycle. The corporate leverage cycle, despite very, very high margins, hasn't really cranked up in a meaningful fashion. And so the GST cut, Fed rate cut, all of this should pave way for bonds to rally meaningfully more from where we are right now.
Okay, so that's the word coming in from some of the market stalwarts talking about where they are seeing the impact of all of these announcements that we've heard, and especially on the GST front. Kapil, just want to get a sense from you on pharma. We were just chatting about pharma a few minutes ago, and which are some of the stocks that are now looking good on the charts, and where would you place your bets when it comes to the pharma space? Would it be pure play pharma? Would it be hospitals? Would it be healthcare, diagnostics? What would it be?
Yes, so in the sector of the PhD, that is a pharma, healthcare, and diagnosis space, there are a couple of the stocks that I have been liking. Let's say from the top tier stocks, so there is one stock, Torrent Pharma. So basically, Torrent Pharma is a more of like engineers oriented, and the stock price structure has been quite good. In spite of many other stocks were sluggish. So the Torrent Pharma can be the one of the good choice at this particular point. The stock is trading at near about by 3,650 level. So finding and expecting the stocks to be remain bullish above the 3,600 level, and the 3,700, 3,780 level can be the upside potential. And from the small cap space, I like the one stock that is in a Newland lab. So that is the ticket size is a little bit high, the 13,500 or so. But after the very intermediate correction, stock is finding its feet again and trying to continue its previous bullish momentum. So above the 13,000 level, I am also bullish on the Newland lab, and on the higher side 15,000 can be the upside potential. So Torrent Pharma and Newland lab can be the choice.
A few scripts in the pharma and laboratory space, which are on the focus radar of our technical expert. But while we speak, the markets are losing some shine from the day highs. As we speak, Sensex has lost the gains from the day highs around 500 points, and Nifty at present still sustaining those levels of 24,800 and above. But Bank Nifty also do see a 400 points downtrend from the day high, 56,156. That was the high in Bank Nifty, which we did see, and at present it's 55,729. Aditya, stock specific moves are many, and if we talk about the EMS category in particular, let's take a look at Amber Enterprises, 7.5%, 8% upsurge. Trend, the stock is really doing good at present. Of course, news flows and announcements are the reason behind it, but at the same time, technically looking at the charts, for the ones who have their existing positions, what will be your recommendation for the same?
Continue to hold is what I would suggest, Mansi. In fact, a lot of these players had corrected recently because of the kind of valuations that these stocks were trading at, and minor disappointment in results led to a bit of a correction. If anything, this news has provided a fillip for these stocks to again head higher. And if we talk about Amber Enterprises, stock did correct significantly, took support at key moving averages, and Fibonacci retracement levels from there, they're again up and away. So my sense is if you already hold these stocks in your portfolio, be it a Sirma, Keynes, Amber, or a Trent, Voltas, Dixon, all of these names that we can talk about, we should continue to hold. If one is looking at a fresh entry, there are few pockets which do look interesting to me, Mansi. We can start with Dixon Technologies. That is one stock which I feel has done its bit of consolidation, and now it's gearing up for its next leg of up move. So for a target of 19,000 on the upside, I will strongly recommend and look at adding the stock in the portfolio. Maybe a staggered buying is what I would have an approach in this stock. So maybe buy 50-60% at current levels. If it cools off to levels of 16,000, it will provide you an excellent opportunity again. And with a stop loss just below 15,500, look for a target of 19,000 on the upside. Again, if we talk about Trent, which has been doing phenomenally well in the retail space, my sense is stock has done its bit of correction and consolidation, and one should look at this stock to be added in the portfolio even at current levels for a target of 6,300 to about 6,500 on the upside, and should be added in the portfolio. And finally, Amber that we spoke of, between Amber, Sirma, and Keynes, I think all can be looked at, but maybe Amber is something which looks more prominent, interesting at this moment, and for a target of 8,000 and above can be added in the portfolio. And all these stocks should be kept in the portfolio at least for a couple of quarters, and you will see significant gains.
That's a take on some of these EMS counters, along with Trent, of course, in the mix. But let's move on from that and let's talk about tariffs now, because the new US tariffs on India should not be viewed as a reason to exit domestic equities. That's the word coming in from Jefferies strategist Christopher Wood, and he calls them instead a reason to add more exposure. Varun is here with more on what that report says. Varun.
Definitely. So Jefferies Greed and Fear report actually says that the previously discussed 50% tariff with the US are not a reason to actually sell Indian equities. In fact, they say that rather it is probably a reason to buy the Indian equities, because it is their view that it is only a matter of time that before Donald Trump backs off the stance which is not in America's actually interest. Also, they say that Donald Trump has actually succeeded in bringing China, India, Russia and Brazil together like never before. on the markets, they say that actually India represents the best long-term structural story in all over Asia, and actually India has just suffered its biggest period of underperformance over the past 12 months in global emerging market context. Also, they say that the Nifty is still trading at 20.2 times one-year forward earnings, which is down from the peak of around 22.4 times, which used to be in October 2021. And following previous such periods of underperformance, they believe that Indian markets actually tend to bounce back after such relative basis. So it's a time to actually buy Indian equities. Also on Fed rate, they say that the money markets are now discounting a 63% chance of rate cuts by the end of the year. Earlier, this was actually around 57%. So the hopes of rate cuts are actually now increasing, and also Jeffries believe that there could be a rate cut in the month of September in the US markets. So if you look at the overall report, it is actually positive on India, and also you will see more rate cuts. In fact, the rate cuts, hope of rate cuts is increasing in the month of September from the Fed.
Okay, so lots of factors to watch out for when it comes to the global economy, especially US, and the impact it could have back home. And of course, Chris Ford is of the opinion that any dip in the market should be bought into. Rajat, while we're talking about that, I want to once again throw some light on defense, because that's also a key theme that we've heard in the Prime Minister's speech, the need for indigenous defense equipment, fighter jets produced in India. So much is happening on that front. Now, while structurally defense seems like a good, intact, long-term story, how should you approach defense in the near term? Because given everything that's happened with defense stocks, the valuations still seem very high. Would you agree with that, or do you believe the valuations now look comforting enough to get a fresh buy into some of these stocks?
No, I mean, absolutely not. I think the valuations, as you said rightly, are astronomical. Like right now, if you look at any of these pharma, any of these defense stocks, it's absolutely through the roof. Hindustan Aeronautics, Mazagon Docks, most of these top 10, 15 stocks which form part of the, defense index funds are right now trading at prices, despite some fall recently, are right now trading at prices where I think in between they became the vanilla flavor of the month when, all these wars were going on. Everybody just wanted to buy defense stocks, particularly after the Operation Sindoor, when there was so much talk of wars. Everybody seemed to find comfort in buying war-oriented stocks and defense stocks. I think that's not cooled off still. There is need for locally manufactured defense equipment. The government is, definitely going to do more investment in this space. There would be higher capex even by private companies. But right now, I would like to stay away purely from a valuation perspective. To talk about valuations and going back to a sector that you were talking about earlier, where I think valuations are very comfortable, where we're looking to buy, is again a sector which is not impacted at all by US tariffs or anything that's going on domestically, which is information technology. So IT stocks have been falling for, God knows what reason. There is a fear that US may do something on these. Companies like Infosys, TCS, which get 80-90% revenue from US, they're essentially American companies. There's no impact of tariffs on these. I don't know why or what the fear has been. So one stock that we've recently added to our portfolio and recommended clients to add is Tata Technologies. This is a stock which about 2 years back did its IPO, hit about 1,200 rupees. I'm talking about Tata Technologies, which is, an engineering and procurement engineering company for, automotive, aerospace, industrial manufacturing. This stock had hit 1,200. And at that time, during its IPO, there was absolute crazy frenzy. And I put out a report. I spoke about it on your channel as well, that, it's a great stock, but I wouldn't like to buy it at that valuation, which was, we was trading at around 80, 82 price to earnings multiple. Today, it's trading below 40. Same stock 2 years later after the IPO. You buy it today and wait for it to hit that price at which it was, you'll make something like, 100% return from this level. It's got a great list of marquee clients, Jaguar, Land Rover, which is, their own sister concern, McLaren, Honda. A lot of these top, and this is the future, home automation and engineering for automotive OEMs. So I really like this company. I waited. And today it's at a price where I'm comfortable buying this. So this is the IPO story really for the last 2-3 years. Look at good companies, let them do their IPO, wait for the prices to correct and buy. So, talking of valuations, IT is a sector in addition to pharma where, as I said, Tata Technologies we've recently added. But that is that.
I agree to that, Rajat. In fact, to the viewers, consider entering the stocks which are in momentum, but also don't forget the stocks which have the flesh, the meat to become great stocks in future. And also, if we talk particularly about the IT sector, while the result season started, IT sector in particular and a larger IT plays were completely a mood breaker. But then last week itself, mid-cap IT plays were also showing signs of momentum. And yes, now is the talks that is the IT sector also trying to make a comeback. And Tata Technologies one such coming on the fundamental radar of our experts. So keep an eye on that as well. But while we were talking about the defense, let's take a look at the shipbuilding space as well. And I will want a technical view. Kapil, if you can give us a view on the shipbuilding space. Aditya, your view on shipbuilding, GE Shipping, Garden Reach Shipbuilder, Shipping Corporation of India, Cochin Shipyard, all of these are trading in green. And yes, of course, it has been a sideways momentum for the last month. But then there was time, and as Rajat was rightly saying, in last 6 months, if we talk about these stocks, they have seen an upsurge of around what? Whopping 80-90% also. Expensive valuation, but do you see now that we can make an entry here?
I believe so, Mansi. There are select counters in which we can definitely make entry, and after that sharp run up that we had seen post the India-Pakistan war, these stocks also cooled off significantly from the peak. Some of them have corrected 50%, 60% from their peak. Some of them have corrected 30-40% from their peak. And some of the stocks do offer an excellent risk to reward if one is looking from a longer term time horizon. So talking of Cochin Shipyard, from levels of 2600, stock corrected all the way to 1600, took support at 200 DMA, formed a small consolidation there, a base formation has already happened there, and now offers an excellent risk to reward. So my sense is one should actually start nibbling into the stock at current levels, again in a staggered manner. Maybe a 50% can be bought at current levels, and if it corrects all the way down to levels of 1500, can be added more. On the upside, if one gives it at least a year or so, can see levels of again about 2400, about 2600 on the upside. Can add a GE Shipping as well in this list. That also looks interesting after a recent up move, stock corrected. Again, a similar kind of a base formation here as well, Mansi, and at current levels can be bought. An excellent is to reward again with a stop loss on the downside at 930, can be looked at for a target of 1200 on the upside. And finally, a Musgao dock, which corrected the least, I think, from the peak, again looks interesting to me, and I would take some kind of a bet in this stock as well for a target of 3400 on the upside, with a stop loss on the downside somewhere around 2600. So all three stocks do look interesting. You can allocate some part of the money of your portfolio to these three stocks in a staggered manner and stay invested for at least a year or so, and you will see a decent upside in all these three stocks.
So that's on some of these shipbuilding stocks. But Aditya, while we have you with us, also want to get your sense on some of the consumer durables that are impacted positively on the back of this GST reduction that we're hearing. And case in point being Voltas and Blue Star just last week. In fact, we were talking about how battered these stocks were. Because of weak earnings, that summer impact. It's not even been a week, and take a look at the upswing, that turnaround story that we've seen for some of these players on the back of this GST announcement. Now, do you believe would be a good time to enter something like a Voltas, because I believe it has bottomed out, or if that is something that you see on the charts?
It's trying to form a bottom, Sneh. I wouldn't rule that out. Again, see, from the peak, from the top level, stock has corrected, Voltas. And if anything, my sense is you're not going to see a runaway rally in any of these stocks, and even in the market per se. That's what I said at the start of the show. That you're going to see a gradual up move in the market, just that the range will shift. Similar kind of a move you will see in all these stocks, be it a Blue Star or a Voltas. Can add a Havels to this as well. My sense is these are good stocks to buy, but don't be in a rush. Don't chase these stocks. Buy them in a staggered manner. Voltas, my sense is a good buy at current levels. On declines, try to add more, closer to about 1250, 1300. Look for a target of 1500 on the upside. Best from the lot is Blue Star, without a doubt. my sense is this stock can be bought at current levels and look for a target of 2300 on the upside. And Havells, again, stock is again going through a consolidation after an up move. Stock again has seen a bit of a cool off from the peak, can see levels of 1700 on the upside. So bet on Blue Star more than anything else amongst the three stocks. But yes, all these three stocks buy on consolidation and on declines, keep on adding them.
That's the take coming in on some of these consumer durables and wires and cables. But on that note, Rajat and Aditya, thank you so much for joining us. We'll let you go as we start winding down